Welcome back to the deep dive. Today, we're digging into something called integrated audits.
That's right. It's basically looking at a company's financial health from two angles at once.
Exactly. Not just the final numbers on the financial statements, but also the internal controls they have over financial reporting, the ICFR.
Yeah, the systems and processes behind those numbers. It's about getting a deeper level of assurance, that the information is actually reliable.
Like a double check system, making sure the process works, not just checking the output.
Precisely. And for public companies, especially the bigger ones, this isn't really optional.
Right, the Sarbanes-Oxley Act, or SOX, comes into play there.
It does. For larger public companies, think market caps over $75 million. Roughly, SOX generally mandates these ICFR audits alongside the financial statement audit.
Though there are some carve-outs for smaller reporting companies, right? Less than $100 million in revenue.
Yes, exactly. So the rules aren't quite the same for everyone,
Mhm.
but for many issuers, it's a requirement.
And what about non-issuers? Private companies, nonprofits?
Well, they can have integrated audits, too. The standards, like SAS 130, are similar, though not identical. It's an option if they want that extra layer of confidence.
Okay, so let's talk about what needs to be in place before an auditor can even start one of these. What are the conditions?
The big one is integration itself. The ICFR audit and the financial statement audit have to be performed together as one project, really.
Using the same benchmark for controls that management uses.
Yes, the control criteria have to align. And the testing the auditor does needs to work for both opinions, the one on the financials and the one on the controls.
Makes sense. And management has specific duties here, especially for those public companies under SOX.
Absolutely. Management must issue its own internal control report. It has to clearly state they're responsible for ICFR and give their assessment of how effective it was.
And for non-issuers, what's required from their management?
It's similar in principle. They need to accept responsibility, evaluate their controls using suitable criteria like, say, AICPA guidelines, and have evidence to back it up.
They need proof.
Right. And they need to document their main control objectives. But here's a key thing. They typically need to provide a written assessment.
A formal written statement.
Yes. And if management doesn't provide that written assessment about effectiveness, the auditor usually has to withdraw from the engagement.
Wow, okay. So that written piece is critical for non-issuers.
It really underscores management's role. The auditors can't just do it for them.
Got it. Now, what about these written representations? Sounds like another formal document.
It is. Both issuers and non-issuers have to provide this. It's basically a letter from management to the auditor.
What does it say?
A few key things. Management confirms their responsibilities again, states their assessment of ICFR and the criteria used, and crucially confirms they didn't just lean on the auditor for that assessment.
So they did their own homework.
Exactly. They also have to disclose all known control deficiencies, including any they haven't fixed yet, plus any fraud involving management or anything else that could cause a material misstatement.
And any big changes to controls after their assessment date?
Yes, that too. Failing to get this letter is a serious scope limitation for the auditor. It's a big deal.
Okay, groundwork laid. Conditions met. How do auditors actually plan the work and test these controls? It's not random, I assume.
Definitely not random. Planning is key. They consider things like the industry, what they already know about the company, how complex it is, how management evaluates its own controls.
And materiality and risk. Are those the same as for the financial statement audit?
Yes, the concepts of materiality and risk assessment are consistent across both parts of the integrated audit. It helps focus the effort where it's needed most.
I've heard of a top-down approach. How does that fit in?
Yes. That's fundamental. Auditors don't start by checking every single transaction control. They start high level.
Like at the company-wide level?
Exactly. Looking at the overall financial statements first. Then entity level controls things like the control environment, the tone at the top, management's risk assessment process, how they handle potential management override, that kind of thing.
And if those top-level controls seem strong,
It can potentially reduce the amount of testing needed on specific lower-level controls. It's about being efficient while still being thorough. And a big focus throughout is fraud risk.
especially management fraud.
Yes, and the risk that management might override controls that otherwise seem effective.
So when they test specific controls, what are they looking for?
Two main things. Design effectiveness, basically. Can this control, if it operates properly, prevent or detect a material misstatement?
Okay, does the design make sense?
Right. And second, Operating effectiveness is the control actually working the way it was designed to, and is the person doing it authorized and competent.
How do they check that? Just ask.
Oh no, inquiry alone is never enough evidence. They use a mix. Walkthroughs, where they trace transactions. Inquiry, yes, but combined with inspection of documents, observing the control being performed, sometimes recalculation or reperformance.
A combination of techniques.
Definitely. Oh, and sometimes for certain automated controls where the general IT controls are good and the control itself hasn't changed, they might use benchmarking.
Meaning they don't have to test it fully every single year.
In low-risk situations, potentially yes. It's another efficiency tool if the conditions are right.
Okay, testing done. Now they have findings. How did they decide if a control problem is a minor issue or a, major one?
They look at deficiencies and classify them based on potential impact. It comes down to likelihood and magnitude. Could this deficiency result in a material misstatement in the financials?
And how likely is that?
Exactly. Based on that, it's either just a deficiency, a significant deficiency, or the most serious category, a material weakness.
What signals a material weakness?
Some classic indicators are fraud involving senior management needing to restate previously issued financials to fix an error, or if the auditor finds a material misstatement that the company's controls should have caught but didn't.
Even if no actual error happened yet.
Yes, even if no misstatement actually occurred, a severe enough control weakness can still be deemed a material weakness because the risk is high.
Can other controls sometimes make up for a weakness?
Sometimes. Auditors consider compensating controls that might mitigate the risk from a specific deficiency. It adds nuance.
So they gather all this evidence.
And form an overall opinion. Is the company's ICFR effective or not, as of a specific date? They also look at management's own report on ICFR.
To make sure it matches up.
Well, to make sure it includes everything it's supposed to, management's responsibility, the criteria used, their actual assessment, the as of date, and importantly, disclosure of any material weaknesses they identified. If management's report is incomplete or, say, fails to mention a material weakness the auditor found, the auditor's report will point that out.
Okay, so let's crystallize the main differences. Financial statement audit versus ICFR audit. What's the core distinction?
Purpose, really. The ICFR audit opinion is specifically on the effectiveness of the internal controls at a point in time, like year-end.
Whereas the financial statement audit
Uses the understanding of controls primarily to plan the audit, figure out how much substantive testing of account balances and transactions is needed. The goal is an opinion on the financials themselves.
and the scope of testing differs too.
Generally, yes. For the ICFR opinion, the auditor needs to test controls over all relevant assertions for significant accounts. For the financial statement audit, they might test controls, or they might choose a primarily substantive approach for some areas, meaning less control testing.
So ICFR audit usually means broader control testing.
Typically, yes. And how and when deficiencies are communicated also has slightly different rules and restrictions.
It really sounds like these two audits are tightly linked, though.
Oh, absolutely intertwined. The results of testing controls for the ICSR audit directly impact the nature, timing, and extent of testing for the financial statement audit.
And vice versa.
Definitely. If the auditors find a material misstatement during the financial statement audit, that's a strong indicator of a potential material weakness in internal controls. One informs the other constantly.
So wrapping up, integrated audits give you that much more holistic view, right? It's not just are the numbers right, but are the systems to get the numbers right working properly?
That's the essence of it. You're looking at the outcome and the process. And while SOX makes it mandatory for many public companies, the value of understanding control effectiveness is huge for any organization that cares about reliable reporting.
It provides critical context for those financial statements.
For sure. It builds confidence.
So here's a final thought, Tanu. Considering this focus on the underlying process of financial reporting, how does knowing about the strength or weakness of internal controls change how you might view a company's reported results? What questions does it raise for you about the organizations you rely on?
Good question to ponder.
Thanks for taking this deep dive with us today.